Here's a bit of shifting gears. Up until now, our focus has been on federal taxation. However, here in the U.S., most states have a state income tax. We need to examine when a state can tax, which we do in this video, and then how that tax works, which is the next video. On with video T13A on State Tax Nexus. So, some of you might be lucky enough to live in a state with no individual state income tax. If you're a business owner, you might prefer a state with no corporate income tax. Either way, you can see that most states have one or both of these taxes. Before we get started on how state income taxes work, I want to point out that state income taxes are generally deductible for federal income tax purposes, which is that state income taxes paid reduce federal taxable income. If a corporation has $10,000 of income and pays a 5% state income tax, that lowers the amount of taxable income for federal purposes, leaving only $9,500. As a result, the net effect of this 5% rate is only 3.95%. Okay, with that behind us, I want to talk about Gene and Agnes Lipsowitsky. Gene and Agnes are from Utah, but each summer they drive to San Diego to enjoy some nice weather and to visit the beach. They also love to visit Taco Surf, their favorite taco shop. Now, if Utah has their way, they claim that Taco Surf is selling to Utah residents, and as a result, Taco Surf should be paying Utah state income tax on that income. How would Taco Surf feel about being subject to income tax in Utah? They have no stores in Utah, no employees in Utah, frankly, no property whatsoever in Utah. In fact, there's no real connection to Utah in any way. Left to their own devices, states would probably try to tax Taco Surf anyway. The term nexus is that minimum connection required for a state to tax an individual or a business. Nexus is a concept, which means that each state is going to try and define that concept for itself. Let's take a state like California as an example of how Nexus is going to be defined. Now, admittedly, California is notoriously aggressive. So California says if you are organized in California, we can tax you. And I guess being organized in a state can reasonably be construed as a close enough connection to warrant nexus. Then California, in its inclusive fashion, says if you are registered to do business in California, that's a close enough connection. But California wants to be really inclusive. And thus, if you are doing business in California, whether you are incorporated or registered, that is still a close enough connection for Nexus. Then California helps us understand what doing business means, which is engaging in any transaction for profit. Wow, I feel so close to California. They really want to include me. Thanks. In case there was any question, however, California wants you to know that, quote, it is not necessary that the corporation conducts business or engages in transactions within the state on a regular basis. Even an isolated transaction during the year may be enough to cause the corporation to be doing business, end quote. As I like to joke, does that mean if my flight from New York to Tokyo has a layover in LAX and I open up my laptop or phone and respond to a few work emails, am I doing business? California would certainly lead me to believe that. Thankfully, between the federal government and the Supreme Court, the state's ability to exert nexus over even the most insignificant transaction is put in check. The first is two clauses of the U.S. Constitution, the Due Process Clause and the Commerce Clause. Without going all lawyer on you, the Due Process Clause basically requires a state to have some minimum connection and a value derived for nexus to exist. The Commerce Clause gives the federal government the power to regulate commerce between the states. And under an important Supreme Court case, the court stated they would uphold a state tax if it meets the following four conditions. 1, It's applied to an activity with substantial nexus. 2, it's fairly apportioned. 3, it does not discriminate against interstate commerce. And 4, it's fairly related to the services provided by the state. All right, so at least now the bar is raised to substantial nexus. But guess what? The definition of substantial still really sits within the power of the states. This is a line that continues to move, not particularly quickly, but it keeps being pushed as states try to expand revenue opportunities. There are certain situations that almost certainly provide for nexus, that minimum connection. That includes ownership of property in a state, having employees in a state, or generating income in a state. In what could only be described as a coup for the mail order and phone order business, in the pre-internet era of the 86th Congress, which was in the late 1950s, the federal government passed another restriction. It's narrow, but it is meaningful. It states that the activities that are limited to mere solicitation of tangible goods do not rise to the level to create nexus. In another important court decision that was related to sales and use tax, the court held that some physical presence is required for nexus. Now, the Quill holding has been under fire ever since, as non-physical forms of nexus have been created and withstood court scrutiny. For example, economic nexus and factor nexus are standards that are currently employed at the state level and waiting for their day at the Supreme Court. The Supreme Court is scheduled to hold a very important case in the summer of 2018 related to this issue of Quill, and the tax world is waiting to see what will happen. Okay, that's nexus. Let's consider how state tax can affect individuals, and we're going to use California as an example. As one of the more aggressive states, it seems likely that this would be the high water mark for defining state tax residency for individuals, because individuals do not have nexus per se. Instead, individuals are taxed on income earned in the state regardless of the state of residency. Typically, a state either taxes only in-state income or taxes all income and provides for a state tax credit to diminish the chance of double taxation. Residents typically report all income, whereas non-residents report only in-state income, making residency a very important tax issue. California defines residence as follows. Thus, a non-resident is anyone that is not a resident. California has issued a number of factors that they would like you to consider. Take a moment to read them. So California also provides the following guidance with respect to considering the factors. A closer connection is required. And California says to compare California with other states to make a determination as to where is the closer connection. However, the closer connections test has never actually been recognized by any California statute or any published California opinion as a method of determining residency. It is really only administrative guidance. Thanks for watching video T13A. The next video is on deciding how to allocate income for businesses among the states. It might not be what you expect.